If you're not getting too much risk, like you can more so expect to not have the potential for those higher returns like you could get in the stock market if you are invested in a good diversified way.
Welcome to Unstoppable Podcast with Harry Sardinas, inspiring conversations with influential millionaires, investors, thought leaders, entrepreneurs who are making a massive difference with their innovative products and services, and sharing the challenges and wisdom of how they sold their first million.
So what message do you have for people out there that how to mitigate the risk, and what would be something sustainable? We have to check here that every time that you invest, money is risk involved. And Nick, how about the kind of investment? I'm a big fan of cash flow investments. So any can you share your opinion in cash flow investment versus capital growth? I see a lot of property investors that they say, well, I want to buy a property and, don't worry about it. I want to go up in price. This is what I'm interested in. And my approach is totally different. I prefer monthly cash flow. And if I'm investing in shares and things like that, I would like to perform as well, to generate monthly cash flow. So when you work with clients, if this is something that they need, could you be able to accommodate them, or how this process works?
Yeah, so there's lots of different ways, as they say, to like skin a cat, which I don't know where that expression comes from or why people want to skin cats. But anyways, there's lots of ways you can cut it. Say some people do like to get multiple real estate properties under their portfolio in individual properties, and then they're receiving the rents from the people living in those properties. Obviously, they want to get a cash flow high enough to cover the mortgage or cover all the expenses, new roof, new AC unit, anything like that. But when it comes to just overall, if you're talking about a general investment portfolio out like diversified among stocks and maybe some bonds as well, you can even do it that same sort of way. You can have a portfolio invested very diversified among, hundreds, thousands of stocks in various asset classes between US, large cap, small cap, dividend paying, growth, and then some international as well. When you've got a portfolio like that, you're quite diversified. You don't have all the eggs in one basket over various sectors, and you can slowly sell off little chunks here and there to pay a consistent cash flow. We do that for a lot of our clients that are in retirement and taking out money. Say they're taking out, 15K a month to live off of. We've got a portfolio set up based on their comfortability and risk tolerance and their goals for their money and their timeline and everything, where we're able to make some small sells each month to be able to pay that cash flow. Based on which of these sectors are up and down, we can kind of optimize their portfolio that way so that we're not just putting all the eggs into, say, US big tech. If that goes down, 1 month really hard, like it did back in April, that would be tough to try to give them their 15K that month when it just dropped 15, 20%. So we want to make sure we're diversified and not subject to too much standalone risk in one sector.
Finance, Nick. Why you decide to become an entrepreneur and to have your own business?
Yeah, it started when I was younger. I grew up seeing my dad building his own business as a financial advisor as well. He started out with a big corporation and then went to the independent side to just get his own clients and be working for himself early on in the business back in the early 90s. And so I saw that growing up, and I liked, he'd have his annual summer party at our house and his Christmas party and invite all of his clients and family and friends as well.
Customer appreciation parties in your own house.
Yeah,
right?
Yeah, exactly. But I got to meet a lot of them, and I saw that all of his clients with whom he works, they're all just really good friends of his as well. It's a business of relationships. And I really
And also they were happy as well.
Yeah,
Because
exactly.
somebody cares about this. See, Nick, there is a lot of people out there that would tell people, elderly people, they're very vulnerable. We tell them anything just to make some money, and and sometimes they are exposed to huge high risk. Um, but when there are relationships in between, and when you actually care about your clients, um, could be a great plus. So you follow your dad steps.
Yes. So followed his footsteps, and I just got interested at a young age. He set up college funds for us when we were younger. And whenever we would put money into our college fund that he would invest and it would grow to help pay for our college, he would match it dollar for dollar. So if I put in $200 from birthday money, he would put in another $200 into my college fund. So I could see that compounding growth.
Oh
And
wow!
I
So you
liked
learn about
that.
compounding in your
Yeah,
own bank account,
exactly.
yeah.
And that's kind of what piqued my interest. And then I just
Mhm.
started diving really deep into it, studying finance and economics a lot through high school growing up and then into college as well. And I kind of knew I wanted to enter this field, especially what you just mentioned with the building the relationships. It's funny, like you said, it's hard to, in a business like ours, wealth management, where we work as a lifetime financial partner with our clients and we have to know as much as we can about their lives, their personal goals, their kids, their everything about their lives almost. And when you are doing that, you end up becoming pretty good friends with them. So, like you said, when you are friends with someone, it also takes out that risk of wanting to be a quick trick artist and trying to, what do you call it, like a snake oil salesman, you end up building a long-term relationship with these people and you have even more skin in the game because you do genuinely care about them to want to do as best as you can. Obviously, you also have the legal fiduciary obligation, but that helps building that relationship.
I'm building wealth. So Nick, how you deal with adversity? For example, COVID was something that nobody ever was expecting that would could happen, and this is and had a huge impact in the markets out there, and how the investments perform. So how do you deal with the adversity, and any any advice that you can share with us?
You're saying when, for example, like as COVID as an example of a big market drop,
Or on adversity, right? For your clients. So
adversity, yeah.
yeah, adversity, yeah.
Yeah, no, that's a great question. And the big thing is getting yourself set up in a way preemptively so that you're not subject to getting hit too hard by one big event. For example, the tariff craze from the US this last April. That could have huge effects around the world, obviously, but one of the bigger sectors that got hit hardest in April, it's now come back the market, but who knows what's to come in the future. One of the biggest sectors that got hit hardest was US big tech companies. And so we want to make sure that we're not just throwing all the eggs in one basket of just one little sector that could be hit hard. Say AI gets too good and the whole sector is wiped out. We want to make sure we're in many different sectors around the world so that we can withstand a big adversity instant like a COVID or tariffs or a new war starting.
Yeah, there are because it's about mitigating the risk, and the mitigating the risk, variety, and don't put your eggs in one basket. All eggs in your basket are a very important element, but also be realistic, Nick, because a lot of people go and say, look, I want to double my money. I want to this return. So can you share with us what is realistic in terms of returns for the investment, cash flow, some vehicles out there, good vehicles. So people that want to know more, they can actually contact you, but they have a little bit of education. What is actually is realistic and is good and is out there, and what actually somebody come to tell you, oh, you see, you double your money, you this, you need more to do more research in what's the vehicle that they are using it. It can happen, but it needs more due diligence, right?
Yeah, for sure. There's lots of good ideas out there, and people can promote lots of different products. However, what it comes down to is you want to look at luckily we've got about 120 years of stock market data since the 1920s. And you can look at these, or 100 years or so, you can look at these 100 years of data and see that the market does go in one direction, upward and to the right. However, you have lots of bumps along the way. You have the Great Depression of the 1930s. You have COVID in 2020. You have the Great Financial Crisis in '09. You're going to have these bumps along the way. But when you just look at the overall averages, the S&P 500, for example, just the US market of mostly large cap stocks, it goes up over those last 100 years about 8 to 10%. And then you have various sectors that can be a little more volatile, but go up a little higher. Say small cap stocks, they're a little more risky, but they could achieve slightly higher than the S&P in the long run. But everything's always changing. You never can know which sector will be the winner in any given year. The big things you need to keep in mind are that there is ongoing inflation in any country where you have a printed fiat currency. So we had great times in the US of 1% to 2% inflation the last 15 years, but just recently since COVID, now we've seen higher years of inflation. Nothing compared to some other countries, like in South America, for example. However, knowing that there's going to be inflation every year, we do need to make sure that our money is working for us and not just being stuck under the mattress and losing to inflation each year by anywhere from 1% to 5%, say, in the US. So whether it's a mix of stocks and some bonds, like government bonds or anything, you need to get diversified and look at the data for
bonds
the
are
last
safer, but they give less return, right?
For the most part, yes. And there's different flavors of bonds too. You can have the corporate bonds versus government bonds, which will be more risky and maybe pay a higher return, but you have
and the returns oscillate between how much which numbers?
What's that?
The returns in bonds oscillate between which numbers, just for our audience?
Oh, for the long run, I guess it depends on which sector.
Yeah.
Typically,
let's say corporate versus government ballpark, so our listeners have an idea.
Yeah. So just take U.S. short-term government bonds over the long run. They're for the most part always going to be just above inflation. So right now, if short-term government bonds are paying about 4.5%, we're seeing inflation at about 4% or so, or 3.5%. This is always, whether it's a short-term government bond in the US or a high-yield savings account or a CD, a short-term CD, those things are always going to be just above inflation. And sometimes people can think, oh, CDs are paying 5% right now. Well, what's the inflation going on right now? And it seems like it's a high number. However, if you look back 5 years ago when CDs were paying, say, 1%, inflation was also down towards that level. So there's return and risk are quite correlated. If you're not getting too much risk, like the short-term government bonds or CDs or high-yield savings, you can more so expect to not have the potential for those higher returns like you could get in the stock market if you are invested in a good diversified way.
Follow us for more interviews with world's most influential, audacious entrepreneurs that overcame challenges and adversity, providing you with the blueprint of how they sold their first million so you can grow your business exponentially.